Ever pondered how to dip your toes into the vast sea of stock market investing? It's an enigma to many, leaving some on the sidelines of a potentially rewarding endeavor. The stock market, an arena where fortunes are made and lost, can be intimidating for beginners. But it can also be a place of numerous opportunities with the right knowledge and strategy. Today, we're set to demystify this vast and complex world and providing you with a comprehensive guide on how to choose your first stocks wisely. Our focus will be on understanding the basics, breaking down the seemingly complex jargon into simple, digestible terms. We will guide you in developing an eye for promising stocks, helping you make informed decisions. The idea is to transform this daunting place into an exciting journey of financial growth for you. So buckle up and get ready to take notes, because this is your beginner's guide to stock selection. The first step in this journey is understanding your investment goals. This is vital because your goals will not only dictate your strategy, but also the level of risk that you're comfortable with. The process starts by asking yourself a few key questions. Are you looking to achieve short-term financial successes, or are you aiming for a stable retirement nest egg? This is a question that demands a clear answer, as it significantly influences your decision-making. If you are looking for short-term gains, the stock market is certainly a place where you can potentially make quick profits. However, this typically requires a significant understanding of market trends and the willingness to accept a higher level of risk. You may consider investing in stocks with high volatility. These are stocks that experience significant price changes over a short period, which provides opportunities for quick gains, but also comes with substantial risk. On the other hand, if your aim is to steadily build a retirement nest egg, a different approach is necessary. Here, consistency and longevity are key. Making hasty decisions for quick profit could jeopardize your long-term goals. In such a case, dividend-paying blue chip are usually a safe bet. These are shares in large, well-established companies with a history of reliable performance. They provide stable returns and less risk, making them ideal for long-term investment. Your goals will shape your investment strategy. For short-term gains, consider stocks with high volatility. For long-term stability, dividend-paying blue chip stocks are usually a safe bet. Step 2 is doing your homework. Undeniably, research plays a pivotal role in the process of selecting a stock. It all starts with the basics, understanding the fundamentals of a company and the nature of the products or services it offers. It's important to have a comprehensive grasp of the company's standing in the sector, understanding how it compares to its competitors, and appreciating its unique position. Then, delve deep into its financial well-being. Examine the balance sheets thoroughly, study the cash flow statements with precision, and scrutinize income statements meticulously. These are crucial in revealing the company's financial stability and potential for growth. Make sure to study not just the current financial state, but also the historical data. For a more detailed analysis, study the company's performance over the past several years, look trends, study the fluctuations, and try to understand what caused them. This can help you anticipate future performance. Yes, remember that no guarantee that past performance will replicate itself in the future, but it serves as a valuable tool, providing you with invaluable insights and a foundation for informed decisions. Remember, past performance doesn't guarantee future results, but it can provide valuable insights. Step 3 encompasses understanding the intricate dynamics of the market environment. It's important to remember that the stock market doesn't exist in an isolated sphere. Its fluctuations and trends are governed by a complex network of external factors that continuously influence its trajectory. These factors are numerous and varied, encompassing everything from global economic indicators to geopolitical events, and from industry-specific trends to the behavioral patterns of individual investors. Each of these elements can exert a significant influence on the market's overall direction, dictating its ebbs and flows, and having the potential to dramatically affect your investment's performance. For instance, changes in economic indicators such as interest rates or employment figures can trigger significant shifts in market sentiment, while geopolitical events like elections or international conflicts can introduce uncertainty and volatility into the market. Similarly, trends within specific industries can signal potential investment opportunities or warn of impending downturns. Amidst this kaleidoscopic array of factors, one thing remains paramount: staying updated with the most current news and being able to understand, analyze, and anticipate how these factors could impact your potential investment. Step 4 in our journey is valuation. Valuation is a fundamental aspect of investing. It involves determining whether a stock is underpriced or overpriced. This involves a delicate balance of analytics, market trends, and industry knowledge. One must always consider the inherent risk with the current market value of the stock. A commonly used method for accomplishing this is known as the price-to-earnings ratio, also commonly referred to as the PE ratio. This methodological approach compares a company's current stock price to its earnings per share, providing a useful metric for potential investors to gauge the relative value of the stock. The PE ratio plays a critical role in the determination of a stock's value. It provides a simplified picture of the market's expectations of the company's future growth and profits. A low PE ratio could indicate that the stock undervalued, providing a potentially lucrative investment opportunity. However, it's important to note that this isn't the be-all and end-all indicator. Other determinants such as the company's growth prospects, market conditions, and even global economic trends can influence the true value of a stock. Thus, while a low PE ratio could indicate that the stock is undervalued, remember, other factors may also be at play. The 5th and final step is diversification. Diversification is a strategic approach that is widely advised by financial experts globally. Essentially, it's a preventative measure, a safety net. Just like in any aspect of life, it's not wise to place all your hopes and aspirations into one singular entity. The same applies to your financial investments. The saying, "Don't put all your eggs in one basket," is not just a saying, it is a sound piece of advice that holds a lot of weight in the world of investments. When you decide to invest, you are essentially taking a calculated risk, a gamble on your future. The whole point of investment is to grow your wealth, and no growth occurs without risk. There's a strong possibility that you may lose it all, or conversely, you could gain exponentially. That's the essence of investing. However, with diversification, you are spreading that risk. You are dividing your funds into various sectors. Diversification allows you to invest in different types of stocks, from technology to healthcare, manufacturing to agriculture, and many more. This way, you are not reliant on the performance of a single sector. If one sector fails, you still have investments in other sectors that could potentially offset the loss from the underperforming sector. Moreover, it's not just about sectors, but also about different types of stocks: growth stocks, valued stocks, dividend stocks, and others. Each of these types of stocks has its own advantages and associated risks. By diversifying, you are taking advantage of the benefits of each type and mitigating the associated risks. This is the beauty of diversification. You are not just mitigating risk, but you are also optimizing your chances of earning returns on your investments. So remember, diversify. Spread your investments across different sectors and types of stocks to mitigate risk. In a nutshell, the quintessential 5 steps for novice stock selectors involve identifying your investment objectives, carrying out detailed scrutiny, grasping the market milieu, appraising the worth of the stock, and adding variety to your portfolio. Keeping investing in the stock market incorporates risks, and the need for patience. Staying updated is vital. Remember the old adage, Rome wasn't built in a day, and neither will your stock portfolio. Therefore, remember to pace yourself, diligently conduct research, and base your decisions on solid facts. Now that you are equipped with the rudiments of stock selection, it's time to set sail on your investment expedition. Happy investing.